Hi, everyone, and welcome to the Amber Data Derivatives podcast. I'm here with Gordon Grant, who's the managing director of sales and trading over at Genesis Trading, basically overseeing the spot desk as well as the vol desk. Gordon, how are you?
Great. It's great to be on here, Greg. Well, or shall we just say Greg? Mr.
Greg Long is
Maggie,
nice.
whatever you like.
For those who don't know, me and Gordon have a nice connection where we speak in French a lot, so that's where that comes from. So
That's how you know we're true quants. No French, you can't be a real quant. Simple as that.
So Gordon, you have actually a really nice background. I was wondering if you could just touch on that before we jump to the Genesis trading side, just so listeners can understand sort of your experience in the markets and in traditional markets before going to crypto.
Yeah, absolutely. So I graduated way back in 2006 with a degree in econometrics and quantitative finance from fine New Jersey State educational institution, and then I got into portfolio management at a large multi-strategy hedge fund, principally focused on emerging markets and macro assets. So I started trading actually. Yeah, about the time I graduated. I started working in 2005 while I was still working on my senior thesis, and had close to 10 years under my belt doing commodities, foreign exchange, fixed income, credit vol, equity index vol, as well as pure vol products like VIX, and traded through a pretty diverse array of market conditions, including the global financial crisis, the great reflation trade, as well as toward the end of my career at the hedge fund, the taper tantrum, right, where we saw the first throes of like markets blowing up because the Fed was trying to raise rates. At that time, they tried to raise them, I think, by 100 basis points, right, to get them back to 2%. It didn't go so well. So really spent a lot of time knee deep in doing quantitative volatility surface modeling, cross asset class, and looking particularly at commodities and foreign exchange to start, and understanding how markets like precious metals and G10 and EMFX options were allied, looking at some of the higher order moments and how things like skew and kurtosis were behaving, as well as some kind of the distributional noise and some of the more stochastic considerations that were occurring in those asset classes, especially during the context of, the GFC and reflation trade and stuff coming after that. So very much quantity by background, very much systematized, if not totally systematic and process driven in terms of how I think about markets.
Yeah, that's fascinating. I want to jump into that a little bit more because there's a lot there. So when you're like working at a multi-strat global macro fund and you're looking at vol surfaces from different asset classes, is there any sort of like complexities that you have to adjust for? Maybe like bond markets have sort of a component with interest rates that affect it a lot, and currency pairs have a little bit of that as well. Like, how do you think about that?
Absolutely. So rate vol was one of the later, interest rate vol was one of the later products that I got into. And for those who don't know, right, rate vol is quoted entirely differently. You quote it in BP vol, right, because you want to try to talk in a way that is homogeneous across all tenors. And it makes little sense to talk about price volatility on 2-year notes and 30-year notes because it's just not comparable. The interest rate markets don't trade that way. People tend to think about basis point volatility. So, you talk in, sort of normal vol or BP vol as opposed to price vol. So that's a first different consideration. And then there are, of course, the distributional elements associated with it. When I got into rate vol, we were near the lower bound of interest rates. It was in the full throes of zero interest rate policy. And so, the only skew that there was for out of the money pay or swaptions, or right out of the money puts on fixed income product for higher rates, because essentially there really wasn't much room for rates to go down anymore, and no one wanted to own optionality on rates struck at, let's say, sub 1% on a 10-year note or something like that. So there were quite interesting trades that you could do through the forward space because this was just incorrectly priced, right? So you would look at things like forward swaptions, and then there's a whole forward volatility surface, not merely for the spot vol surface, but the forward one. So you would say something like, what is the term structure of 10-year forward rates, right? So you have 1 month into 10-year, 6 month into 10-year. And so there's this whole multi-dimensionality to the forward strip and the vol surfaces associated with it, not just rates. And then Forex, Forex is interesting because you're really talking a lot more about correlation, right? So Forex, there are deep liquid markets for cross-currency options. It doesn't exist in crypto yet much, although Genesis has traded some of the world's first EBTC options. But in Forex, you're trading cross product all the time. Euro yen, Aussie yen, Kiwi yen, Euro Naki, CAD Naki, right, all the time. So there is a well mapped and actually sort of traded correlation and covariance space. And so a lot of the time, what you actually think about and how you build volatility surfaces may well be from some of these cross products. So if you're making dollar pair markets and you're thinking about, okay, what is the skew or convexity embedded in something, let's say like a dollar Norwegian krona space, that surface doesn't actually exist in and of itself. It only exists as a euro Norwegian krona volatility surface. And so then you start to look at Euro Norway, dollar Norway, and therefore you're looking at correlation between those pairs and then the sort of intermediate pair, which is of course euro dollar. So Forex very much correlation driven space, rates very much sort of a multi-dimensional forward space, and then commodities, right, have their own own kind of distributive risks where essentially different points on the contract curve are totally non-fungible, right? And that's somewhat unique too, because in Forex it's not true, right? Forex, if I trade a 1 month option or a 1 year option, they're going to more or less, the underlying is going to behave the same. Whereas in commodity space, it's not at all the case, right? A 1 month crude oil future and a 2 year crude oil future sometimes have nothing in common, right? Sometimes they're moving in completely different directions. And the same is true in the grains market, which is even more esoteric. So, there are all of these higher orders of complexity, right? One to forward curves, one to futures curves, one to correlation considerations. And, the way that we now think of this stuff, and at that time it was less common, but was coming into the literature, was a so-called factor-based approach, right, to this stuff. And so you want to rebase everything into some factor, factorize constituent component analysis, if you will. So it's, you factor everything off the 1 month. And then you build correlation models around that, let's say for crude oil futures, or let's say for 1 month versus 1 year implied volatility. And the same thing in correlation space. And in crypto, kind of coming back to where we are now today, like factor-based, sort of volatility metrics, I think have some merit, right? And are kind of a cool and interesting way to take a look at some of what we do.
Yeah, that's fascinating. You mentioned something there that I want to dig in a little bit more. So BTC ETH volatility options or optionality. So kind of simplifying kind of recapping what you just mentioned is like correlation becomes a big component. So if Bitcoin and ETH are highly correlated, the pair BTC ETH is going to have some low volatility. But let's say they're inversely correlated, that pair would have huge volatility because Bitcoin goes up as ETH goes down. So the pair moves a lot. Now, would that correlation be like a factor? So you make this volatility surface and you have some sort of estimated range for the volatility of the correlation component itself. And then that's how you would model a surface on a cross pair like that? Or
Yeah, you can. I mean, of course, a correlation-based product is always going to be statistically driven because there is no observable quoted surface yet. We don't have the benefit of a broker market for ETH BTC options, right? Like I said in the case of Forex, right? You want to call somebody up and you say, okay, give me the surface, sort of one week to 1 year at 25, 10 delta risk reversals and butterflies for Aussie yen, Kiwi yen, whatever you want, you'll get it, right? And then you can pull it out from there. In Bitcoin and ETH, we don't have that. So what you need to start doing is looking at historically, right? Where has the correlation been? And the answer is, well, historically it's ranged, somewhere in like the 80+% range for correlation, not beta. And then you want to look at, okay, how has that correlation shifted towards the extrema of that distribution, right? So if this is around some kind of zero drift, mean, well, what is it in the kind of 10 delta portions of that smile? And yes, and you do exactly as you say, you start to bootstrap a volatility surface around that for the cross, which is to say steady state, right? You tend to observe locally a high degree of correlation between ETH dollar and BTC dollar pairs. But as you start to get into the extremes, well, maybe that correlation can break down. And we've seen that this year, in fact, right, where one of the great trends of 2023 has been the flippening, not in ETH market cap over Bitcoin market cap, but in Bitcoin implied volatility over Ether implied volatility, right? As we all know, those of us who have lived and breathed this space like you have at Amber Data, and before that, your baby GVol, that you guys were one of the first, maybe if not the first, pure vol player in crypto. Like ETH implied vol was just, you wake up, the sun rises, and ETH implied vols are plus or minus, 15 to 20 over BTC. Why? Well, that's where they realized. And this year we saw that huge compression. And part of that has had to do with how they behaved on a correlative basis, which was to say when Bitcoin started ripping in Q1 and again in Q2, we had that huge outperformance, of Bitcoin over ETH. And we could discuss why that's happened. But nonetheless, right, if we were trading cross-vol at that time, right, and you were short ETH BTC vol, you would not have been a very happy camper, right? Because correlation started to break down. And I think we all remember some of those days where Bitcoin was up 3-4%, maybe more, and ETH was up, struggling to be up 1-2%, and it wouldn't stay up there that long. And so these are the kinds of dynamics that get involved in correlation pricing, and especially in a high variance space like crypto, correlation can be potentially very toxic. I think that's the takeaway from it. So it's a space that we have quoted and traded with clients. We do have statistical models around, but I think it's going to take some time for that to mature. But it's super interesting, and it's something that we do keep a close eye on because it informs other elements of volatility pricing and considerations that are of a quantitative nature.
Yeah, cool. One more kind of question here on this topic before we sort of move on. So in options, in regular options trading, sometimes there's kind of systematic strategies like harvesting the variance risk premium. When you're trading relative vol on like a global macro multi-strat desk, are there some like strategic or systematic strategies that you look at all the time? So let's say like extreme like correlation points or things that you expect to mean revert on sort of the relative vol basis. Like how would you look at that?
Yeah, I think so. I mean, there's a portfolio manager mindset that kind of comes into place that's different from being, let's say, a cross-asset volatility market maker, right? Imagine that I'm a market maker and I don't just quote Bitcoin and ETH options, but I quote BITO and I quote Riot, Marathon, and Coinbase and MicroStrategy options. That would be a really cool job to have. Maybe someday I'll be lucky enough to bring that into the Genesis fold. But as a market maker, it's different than a PM. But in the PM mindset, right, yes, you do have those kinds of strategies, right, quite clearly. And, it flips both ways. And so some of my favorite trades, right, as a PM within that kind of VRP space, would be after, let's say, kind of a crisis. Well, you would have an ability to harvest tremendous VRP from some of these cross-yen pairs, right? And I remember, some of the best trades and probably luckiest trades that I did, post-global financial crisis was like selling convexity on cross-yen pairs because it had blown out to this incredibly high level. So you weren't just, harvesting volatility risk premium, you were harvesting vol risk premium, right? Which is really sort of getting into the weeds. But conversely, right, when times are good, pre-Lehman especially, and then again, sort of pre-taper tantrum, there was an opportunity to pick up that convexity very cheap, right? Because the market had endured years of just sort of grinding itself, down to oblivion. And you can sort of look and ascertain probabilistically at what point is that stuff going to realize. And in foreign exchange, I think more so than almost any other asset class, maybe precious metals to a lesser extent, there was a huge degree of mean reversion within time processes of volatility and volatility-based moments, which is to say, skews tend to normalize over time. Convexity tends to normalize over time. Kind of median levels of at-the-money implied volatility tend to normalize over time, both to the plus and the minus. And so Forex really lends itself well to those kinds of systematized vol strategies. And I do think that there are players that are probably coming from that background and bringing those into crypto. It's interesting to see them be tried. I perceive them to be tried in the market based on flows that we've seen. But certainly, so that's one element of it. And then, of course, there are cross-asset vol strategies. People paid a lot of attention to crude oil versus nat gas, right? Vol, or silver versus gold vol within the precious metal space, or copper, zinc, and the base metal, base metal space. But it's these rely on the same sets of heuristics, right? Which are as you say, mean reversion, trend, or some other more chaotic factor, some stochastic factor that people want to build into these. And I think that kind of forms part of the toolkit that you use as a vol-driven PM. What's interesting now, I would say, is crypto may be becoming a tool for cross-asset PMs out there, right? Maybe these are some Amber Data subscribers of yours that or these are clients at Genesis. But we start to see this kind of flavor where folks that we're trading with and having a dialogue will say, you know what, he kind of thinks about things the way I used to. when I was a PM, right? Oh, I recognize this strategy, right? This curve trade normalization structure where you're buying 3 month and selling 1 year, Vega neutral at the richest point of the curve. And we all kind of know what models people are using and how we're deriving fair value metrics. And that's great to see. And it's very validating to see sort of more intellectually robust investment strategies, trading strategies come into the space that I recognize from my days as a macro PM.
Yeah, that's fascinating. So I said that was my last question before jumping into Genesis, but I do have another kind of follow up, and then we'll jump into Genesis side of things. So you mentioned one of the big trades post Great Financial Crisis was selling the convexity point on Japanese yen pairs. So let me kind of check my understanding with you and see if I got this right. So traditionally, the Japanese yen is a funding currency, so it's really useful for the carry trade. So you can borrow cheap yen and basically go long sort of commodity currencies, Kiwi, Aussie, and earn a yield. The problem is that everyone piles into that same trade, and it becomes sort of a risk-on type of trade. And then when we have a great financial crisis, everyone jumps to get out at the same time. So the yen has this massive rally as people unwind those trades. So you were saying post-financial crisis, there's sort of like a lingering memory of a Japanese yen rally, and therefore you could sell sort of the out-of-the-money convexity or the call side on the yen and earn a overpriced yield, essentially. Is that right?
Absolutely, right. And I should add, right, to my own defense, I'm rarely a short vol strategist or trader, and so I entered into these trades from the high-handed position of having held lots of longer dated, lower delta risk reversals, owning yen calls and dollar calls throughout the global financial crisis. So that made my boss think I was really smart, which was probably not true. I was actually just doing exactly what I said, which was looking at these 2 year, $10 to $20 risk reversals and normalizing them relative to trend and expecting any kind of mean reversion. Just happened the global financial crisis hit, and I had a bunch of these in the portfolio.
Amazing.
But the point was, just as they were great trades to normalize for being long yen calls pre-crisis, they were great trades for normalization to be short yen calls post-crisis. And that's exactly right. Because people were effectively paying for insurance that they didn't need. They were fighting the last war, right? Mm-hmm. And this is an heuristic that many folks have talked about, right? Nassim Taleb, whatever one thinks of him in terms of his metrics as a trader, he's certainly come up with great heuristics to help all of us traders and quants think about the ways that people sort of emotionally identify with risk and fighting the last war, paying for insurance. That distributionally, especially if you believe we're in a Markovian world, you have no reason to believe that you need to expect another 6 standard deviation move in the yen versus the Indonesian rupiah again within the next 6 months or a year, but yet people will continue to pay for that kind of insurance after it's happened. And it's all about pricing, right? So you kind of understand, all right, so I'm paying for sort of 50% daily vol, right? In a pair like IDR JPY, it's like, all right, you can probably sell that, right? Not a lot, but you can sell it and sort of carry the book. And as a cross-asset vol player, there's always going to be vol you want to buy, right? And particularly GFC, right? Vol that you wanted to buy was like precious metal vol. So I can remember, writing investment memos to our weekly risk committee saying, hey, listen, I'm short, IDR yen, yen calls, and I'm using it to fund, let's say, skews in vol and precious metals, right? Reflation trade, precious metals going up, spot vol correlation high in precious metals, and using that as a funding. And that's sort of the mindset of a macro vol PM. That's kind of the beauty of it, right? If at the time I had crypto, right? If we were talking about like the COVID reflation trade, well, Bitcoin calls would have had to be in there, right? Not just gold, silver, and platinum. And Bitcoin has kind of taken on, or in the past at least, taken on that role as the reflation trade of choice. But you definitely have that sort of lens to put a flavor in it.
That's fantastic. So jumping into the Genesis side, so your desk, Genesis Trading, facilitates a lot of flow for customers. A lot of people can't trade on Deribit. They're located in the US, but they can use Genesis as a counterparty to essentially put on option positions and stuff like that. Now, is the Genesis Trading desk only principal? Like, is the risk that you warehouse on a principal basis, or is it ever on a prop basis? For those who don't
it's a fair question. So we think of ourselves as a principal sell side dealing desk, right? Which means that we utilize proprietary capital in order to facilitate client trades, to warehouse that risk and dynamically manage our exposure around that, which is a composite picture of a book of risk. Now, when you warehouse risk and you don't back it, by nature, that becomes, in a certain fashion, more than principle, right? Because I have to have a proprietary view. If I trade with Greg Magadini and I trade with 9 other traders in the street who are all smart vol traders, pretty soon I'm going to have a dog's breakfast in my options book, right? I'm going to get all the wrong positions because I'm going to be doing what we call sort of low edge, high alpha trading for the takers, right? And and I need to get out of that, or I need to show access to the street. I need to show access to my client base in order to rotate that risk. And at that point, right, it becomes a proprietary decision. Now, those proprietary decisions are based on models and robust statistical frameworks, as well as, lifetime's worth of experience in the vol space that I and my colleagues like Ravi Doshi and others, bring to bear. And so, we don't, as a rule, for instance, we don't run systematic vol strats out of our principal capital. No, we don't do that. But we do have a systematic approach or a systematized approach to how we ingest client flow and dynamically hedge it. Someone might say, well, aren't those the same thing? The answer is no. Are they similar? Yes, for sure. Could I take, if I were a hedge fund, right, my principal capital weren't dedicated to a market making business, but instead a buy side strategy. Could I take our models? Could we take our models, our quant built models that we really are very proud of, and go run systematic vol strats? Yeah, absolutely, right. To have a QIS, totally. But we don't. We choose to deploy that technology in order to support and facilitate the client, because that's really where the secret sauce is for us, which is to say, large institutional transactors who want to put on 500, 1,000 units of Bitcoin or more call options, 5, 10, 20K units of ETH call options. We've got to price them, right? We've got to price them in a way that's fair and reasonable, that allows them to get the risk on that they want, us to have a reasonable edge capture in mids, but then begin to go and sort of recycle that risk in the market over some period of time, right? And we know what the table stakes are for hold periods and expected spread capture on trades. And, at the end of the day, this is a return on capital business, right? So we look at it and think about what is a reasonable risk-adjusted rate of return for the kind of client positions that we're able to facilitate and warehouse. We've been doing this for just about as long as anybody in the crypto option space. In particular, we think we know something about it. But that is how we look at it, and that would be the differentiator between a principal trading business, and sort of a proprietary trading business, right? That's how I would differentiate.
Yeah, that's fantastic. That's a really insightful. So, kind of just jumping into how you guys hedge out this risk. So obviously, Derivs is sort of the main vol venue for screens, and then we have other exchanges like Bybit and OKX and ThaleX that's just coming online. Are you guys connected to all those venues, and do you guys also quote trades on Paradigm, like block trades and things like that?
Yeah, we do. We generally are active in all venues that conform to our applicable regulations, pass our own onboarding and other associated compliance smell tests and scrutiny. But provided that there isn't some limitation in terms of a legal or compliance-driven consideration, yes, we'll be active. So, markets like Derivs / Paradigm, markets like CME, right, which is a U.S. North American regulated market. Derivs now is going to be a Dubai regulated, sort of contract market. We are active in all of those, both from a linear risk and a nonlinear perspective. Although Genesis personality over time, because of the quantitative robustness that we have, has evolved, I would say, more into the nonlinear space, i.e. options, although we do still spend a good bit of time pricing and trading linear risk within derivatives.
Yeah, cool. And then from OTC trading is kind of like it's hard to get a lot of good insights into what's going on in the OTC world. From a kind of a volume perspective in the options market, if Deribit was 100% of the market, would you say like Genesis OTC flow is like 5%, 10%, something like that?
Yeah, it varies considerably over time, but certainly you can be talking double-digit integral percentages, right? And I think so. Now, one thing I would add is we tend to think of it as relationship-driven trading, right, versus kind of order book trading. And there are folks out there who are great, and I have a lot of respect for, who are, I think of them more as peers, less competitors, because they do something totally different. But, they vend liquidity directly into the Deribit order book, and they may use Paradigm to do the same. The Paradigm order books or to respond to RFQs. but those guys, they themselves are sort of double-digit, potentially integral percentages, the top guys of the overall Derivs volume. But none of their trading is relationship-driven, right? No one calls them up. A top, ABC crypto native hedge fund doesn't call them up to talk for 30 minutes or an hour about macro considerations, monetary policy, things like the halving, changes in, let's say block size on a protocol, or things like the Chappelle upgrade on ETH, and have a view, have an informed discussion, and then structure a trader on that. That just doesn't happen. That's the Genesis way of doing business. And so, we view our trading really as trading that we do where we might vend some liquidity into the order book, right? Periodically doing what I said earlier, utilizing our principal capital in order to show access and recycle our risk in a way that's value accretive and still is capturing edge to mids. And then the relationship driven trading, which is what I'm talking about here. And we would say that, increasingly, well more than a majority of our trading is relationship-driven trading is of that kind. Now, it need not be purely OTC, right? You can have an OTC style interaction, but you can trade over paradigm. You can have an OTC style interaction, and you could actually just block the trade directly on Derivs, right? Derivs has its own block trade facility too, and you may now be able to do bilaterally negotiated, DeFi trades that are still relationship driven, right? There are things like AVO out there, right? Where someone come and say, hey, RFQ me for Lido options, for Maker options, for BNB options. That's bilaterally negotiated, still relationship driven if you're participating on that venue. But yet it's going to sort of clear in a decentralized format, right? So, we take a slightly more holistic picture about it, but I think it's fair to say our relationship-driven trading volumes, certainly could be getting into those kinds of volumes that are comparable for other large market makers out there, except that where they're vending liquidity top of book, we're providing liquidity on more of a bespoke basis.
Yeah, interesting. So 2023, we saw Bitcoin outperformance, Bitcoin spot vol relationships tilting to positive correlations. Now, traditionally in bull markets, altcoins have this moment of outperformance. What's your take? Is there a trade? Is there a growth for altcoin appetite? Is this the beginning of a bull market that we can see some altcoin outperformance, and is positioning out there cheap for that? Like, how do you think about sort of the relationship that we've seen in 2023 so far? Do you view it as persistent, or something that will mean revert towards sort of traditional altcoin outperformance?
Yeah, working backwards, right? We were just having this catch up internally and having some discussions because now ETH Paris is over. It feels to me that we're at another sort of consolidation and inflection point for the asset class, whereby pools of capital are sort of being reaggregated once more, and people are talking about the VC thesis for crypto, about new opportunities to invest in fresh ecosystems and, let's say revitalized or otherwise undiscovered opportunities. And so, that's kind of happening at the time that there is this discussion of a nascent alt season again. WorldCoin launched yesterday for what it's worth. And there's been a little bit of attention, paid to that, both by detractors and admirers alike. Look, one of the things that's beautiful about crypto and interesting quantitatively is that it will remain ever a fertile ground for this kind of stuff, right? New protocols, be they alternative L1s or be they scalability solutions, such as we've seen with L2s and rollups, or entirely new constructs. And whatever you think of WorldCoin, it's a relatively new construct, right? It's doing something different, solving for a different problem. Based on the conversations coming out of ETH Paris, based on, equity risk proxies, and I'm not a believer that you trade crypto in the aggregate purely on an equity risk beta or sort of factor risk, but it exists, right? The equity trend factor, and certainly it's started to have an influence yet again, not surprisingly, as we're pushing up towards all-time highs in the NASDAQ, that people are kind of coming back to crypto VC, the narrative around alternative L1s, right? There's been some enthusiasm for Solana. Again, it's broken back above 20, 25. And that seemed to be kind of a consensus thesis coming out of ETH Paris. So, look, innovation in this space is evergreen. There seems to be ample capital to be thrown at it, judging by the, kind of notional AUMs of the VCs that are out there sniffing for deals. And I think ETH Paris, was kind of one of those sniffing for deal conclaves. So, Yes, I'm a believer that there can be another alt season. We're starting to see big moves in names like Maker, right? Maker is one of these OG DeFi token names. There's a buyback program that's initiated for it. It's had a huge move off the bottom from roughly $600 to 12, almost $1,200. It's a 100% move in not too long a period of time. We're seeing very innovative projects being launched within the space by some of these crypto OGs, right? Robert Leshner has announced a new platform of sorts that is going to, essentially offer kind of better solutions than the current crop of products that are out there, within the competing ecosystems, and that will continue, right? We've yet to see any of these latest crop of L1s really take off, right? Aptos, SWE, it's hard to see, but I think there's enthusiasm out there. They're still trading. So, as long as liquidity is ample, I think we can certainly see that. And it helps that Bitcoin is up as much as it is, right? It's up 80+% on the year. And we know that when Bitcoin is up that much, people tend to want to take some off the table and re-lever it and stick it into their assets. And of course, alt season means many things. I don't necessarily put memes in the same bucket as alts. I think memes are their own very cool silo, but we have seen some meme outperformance this year when it came to a name like Pepe. And that's also been, to me, a sign. If you look for canaries in the coal mine, and I'm as a macro, kind of original thought process investor or trader, I think there is liquidity out there, notwithstanding the Fed having bumped rates, above the 5% threshold. There is still liquidity out there, and we're seeing that with, major tech stock barometers like NASDAQ being up, with fresh leases on life being given to moribund companies like Carvana, and with some resuscitation of kind of the L1, subset of the crypto asset class, being the Solanas, being the Avalanche. There's others, and there is real innovation, right? I mean, Avalanche has this new so-called Vista program for real-world asset tokenization. Who knows whether it'll take off, but it's pretty cool and innovative. And so those and use cases like WorldCoin, to the extent that you believe in that use case, are starting to be talked about out there. And it's something to kind of distract other than the narrative of Bitcoin, right? And that narrative has been great, and it's played itself out very well this year. There is now the anticipation of these renewed spot ETFs, but I think people's attention spans are short within crypto. Anything that even remotely starts looking like news starts to get faded, and people are much more interested in kind of what is the rumor and the prognostication. We can come back to the news when it gets closer, but there's a little bit of a barbell, right? Which is, the rumor is ingested and traded, then the news cycle is long. As long as it's news, it's not that interesting. And then when it finally becomes fact, right? And then maybe we trade it one more time, like we did the beta launch in 2021. But we tend to live in those tails in crypto, as we do in so many things, from the very earliest, not obvious inception to the actual real world catalyst. And most of the rest of in between is not that interesting. And that's part of what makes this asset class exciting.
Yeah, that's a good mental model. I like that. So kind of just closing up here on some more personal stuff. In your trading career, do you have any favorite trading books that you'd recommend listeners to read? And then follow up on that is, when you're not managing director of sales and trading at Genesis, what do you like to do for fun?
Yeah, sure. So books, let's start. I mean, I had the benefit, as I said, of a first-rate education, and I had some great finance OGs that I studied under, I think they left me with a great reading list, much of which is still on my shelf. So if you're new to markets and you haven't read that much and you want to read just great stuff, pick up one of the original books, The Market Wizards by Jack Schwager. Like, that's it for me. And he has a few different iterations of that series, but he ends up talking to, Paul Tudor Jones, Druckenmiller, Jim Rogers and others. And of course, we like to think in crypto that much of what we're doing is very new and innovative. And much of it is. Here we are talking about trading on-chain RFQs and no longer centralized risk. And we're talking about, sort of cross-asset correlations between L1s and L2 rollups and what all that means. But the reality is, you talk to a dude that, lives on like Park Avenue, wears a bow tie and drives an S-Class Benz. He's probably seen a lot of this in his career, and I think it helps to get into that. And so I find their works to be evergreen. So that's like the discipline of trading. Then there is the macro thought process. And crypto, is macro. That's not my line. It's actually an advisory service run by a former colleague of mine, Noel Atchison, right, who has this newsletter called Crypto's Macro. And it's a great line, right? And I think you have to conceive of crypto that way. When you talk macro, there are lots of great macro investors. I happen to have worked for one of them, Hari Haran at NWI. Druckenmiller is a great macro investor. But for me, there is nobody who is more macro than Jimmy Rogers. And I say that because he took 2 trips around the world in motorized transport by himself to go and explore, opportunities. And this was pre-crypto, right? So there wasn't a digital asset landscape. There was just like EMs, the frontier. So Jimmy Rogers got on a BMW motorcycle and a custom Mercedes SUV and basically drove from Portugal, and circumnavigated the world and went through sub-Saharan Africa, the Middle East, West and Central Asia, right? Southeast Asia, Latin America. And if you want to have his lens of like, how do you look at stuff you've never seen before, whether it's an L1 or an L2, or whether it's, it's a tribe you've never encountered or a monetary system you've never heard of, it's a really cool lens. And I think if you're intellectually curious and adventurous, those are great. So that's like the macro viewpoint. For the quant stuff, I'm a big believer that the best quant work is still yet to come, that big data and, deep learning or, sort of generative AI, which are much like blockchain, stuff we could have done a long time ago, but we can do it now because of the power of computational data processing. The best work is yet to come. And I think you can't really have any glimpse into what trading with big data looks like, but with a little bit more of a medium-term lens until you understand what Renaissance technology is and what they do. And we're all very fortunate, I think, as market practitioners, that book, The Man Who Solved the Market, came out. I don't know why, the folks at Renaissance ever agreed to have those discussions. Maybe it was, James Simons feeling bad that, one of his children passed away. Maybe he wanted to leave something behind other than just a lot of money. But that book is tremendously insightful. I never get tired of going back to it because all of a sudden, after years of sort of guessing like what Renaissance does, it's finally sort of there for you on the page. And if you're at all curious, you can start to think, well, what if I apply some of these principles to my own, trading and risk management? What if I think about simultaneously causal relationships in such a fashion? What if I think about marginal and conditional distributions of pairs? And what does that mean for me? And it really is eye-opening for a whole new world. So those are like some books, and I think those are phenomenal. And the list is much longer, but for a short reading list. Aside from what I do when I'm not making markets at Genesis Trading, well, I'm a very proud father of a 4-year-old son who I'm trying to raise him not in my image, but just leave him with some of the tidbits of understanding the world in the way that I do. So he sometimes likes to kind of meme me and just spit out gibberish and say Bitcoin in between, lots of, blabbering. And I think that's how he perceives my world today. But no, that's definitely a huge thing. And then I think, for getting out all of the energy that you need to have to pursue crypto, I love kite surfing. I think it's one of the coolest sports that are out there. It's definitely out on the fringe of advisability. I don't do as much of it as I used to because now I'm a parent and I also need to consider my job and my responsibilities. Fortunately, no one has told me I need to stop yet. Right, I'm not as important as Alan Howard, who is apparently forbade from downhill skiing at this point. So I'd love to get in the water and be harnessed by the power of the wind and kind of solve those complex multidimensional problems.
Yeah, that sounds fun.
There's nothing quite like, figuring out where the wind is blowing from, what are the changes in the water currents, what are the wave heights, what sort of board and sail power you need to have, how much tension you need to have on the lines, and kind of controlling that all for with just one hand out in the air riding. It's a very free sensation. So and it is very quantitative in its own way. And if you're detecting a theme, it is there's one mindset that I have to almost everything that I do, and whether it's crypto trading or kite surfing, and hopefully it continues to serve me well. But every once in a while you get dragged into the rocks. That was 2022 for most of us in crypto. So, knock on wood, we're all still here talking, you and I. So the world cannot be such a bad place.
Yeah, absolutely. Well, Gordon, thank you so much for coming on. I mean, this interview had a lot of meat to it. So there's a lot of good details that you provided for the listeners. I really appreciate that.
Yeah, with pleasure. Hope to do it again sometime.
Absolutely. And everyone who tuned in, thank you so much. We'll see you next time. Thanks, Gordon.
OK. Merci, Grégoire. Au revoir. Jusqu'à la prochaine.